and Stephanie Larson in California. And of course, we wanted to give say a big hello to everybody and a pre July 4th holiday. We haven't had a video really since April, I think, right, Steph? It's probably
I
been
think so.
since tax time. So
Hmm.
we thought it'd be worthwhile. First off, uh, you never get too happy about anything when it comes to our world, but I'm happy to report that I think the vast majority of you will be very, very happy. You might even be downright surprised at how well your portfolios have done this year.
Hmm.
And I know that there's a lot of interesting news out there in all extremes. I mean, sadly, this is the kind of some of the crazy stuff that happens during election years. People do try to politicize their portfolios, but I will just tell you that Stephanie and I are very proud of what we've been able to accomplish this year. It's a team effort, and we've done our thing. So, anyway, Steph, what do you want to talk about today?
Well, I think you're right. We are due for a video, so I'm really glad we did this. Just want to say hi to everybody. The market's doing, I think, reasonably well. We're doing very well. We can specifically spend a lot of time at the end of the year, really beefing up the research and making sure we really were prepared for this year because we knew it was going to be a different year this year. And we're doing great. I think part of the reason why we wanted to have a video today was that we've had multiple clients, not one or two, about a dozen, that have all asked me the same thing. Is this a top? Are we due for a recession? And really starting to freak out. The problem is that a lot of the pundits and the people that write for the magazines and the newspapers, that's how they sell it. I mean, they have. You're not going to watch somebody if everyone's like it's rainbow and sunshine out there, So they doom and gloom everything, and a lot of the pundits are really trying to scare people, and I really wish they wouldn't. But we wanted to kind of get into some of the things that we're seeing and why we're still kind of bullish, and then to kind of remind people about our risk mitigation protocols, which are very strict and strong and effective. So we just kind of wanted to touch base on this since we're hearing from multiple clients that they're concerned. So do you want to kick off, Ken, or about what
Yeah,
you're
no,
seeing?
just it's important for us to both talk. So,
Sure.
first off, it is true. I do put out a lot of research about seasonality in the markets, and I did one of my last Forbes pieces was about the fact that summers can be very volatile. While it is true, I mean, if anybody who tracks the S&P 500 or the Dow, they didn't end up down. In our case, where we buy individual securities and not index ETFs, we were able to find that better chunk of these indices that are performing well. And by the way, not all tech. In fact, we've avoided a lot of the AI stocks, what we used to call FANG or now the Magnificent Seven, all that other
Yeah.
good stuff. I'm actually, in my analysis, a couple of things that are important for you to know. We actually do have our own equity index. I call it the WILSI, the Legacy Stock Index. And it is interesting that a lot of the old type of tech stocks have actually vastly outperformed the AI stocks. Go look at something like Intel. I mean, it's had an unbelievable year. It's old. It's an old school company, as many of you know. They were based down in Silicon Valley. But what I will tell you is this, from our perspective, looking at the overall market, uh, a massive number of the stocks in our index, well over 70% of them, are above their trend lines, meaning they're going up. There's more buyers than sellers. But again, with that, there are some areas of the market that have gotten badly mauled. I would suggest that anybody, and I bring this up on our podcast. For those of you who haven't seen my podcast yet, I probably should have worn my cowboy hat today. You might have recognized me a little better, but decided not to wear it. It's a little warm out here. But with that being said, look, I think there's some serious explaining that needs to be done by some of our competitors. The people that were promoting Bitcoin, you have some, I mean, it's down almost 30% on the year. Those people who bought very late to the party on gold and silver and didn't take profits, you have some explaining to do. And I think anybody who sat there and watched the volatility that's happened in a lot of the new tech stocks and crypto stocks, same thing. So there are, I'm happy to say the Winans clients have had a good year, but not everybody out there has. And that's also why some of the pundits who are trying to make up for their bad performance are downplaying this rally. That's my honest assessment. They're trying,
Yeah,
it's a CYA,
yeah,
and because they screwed up.
I would agree with that. And I think we were just talking just a few minutes ago about it. The dollar strength is real. So the rally is strong, the breadth is strong, the volume is strong. There's a lot of technical indicators out there that are showing that this rally has some legs to it, right? But I think also it's really important to mention, one of the clients I spoke to asked, well, should we just change sectors? It's not even sector driven. It if you last quarter for earnings, we had two stocks. One of them, they're both infrastructure plays. One of them made earnings and popped 50%. The other one missed earnings and dropped, I think it was about 40 in a day. So Primoris tanked. It's an infrastructure play based out of New York. Well, Sterling is based out of Texas, where all the AI infrastructure is being built. And so even in the same narrow market, the stocks can have massive divergence. So really it kind of says it often, but it really is a stock picker's market right now. You can't just buy ETFs and buy beta and expect to do well. It's just not that case. This year is very, very technically driven, and it's very stock specific driven.
Yeah. And I'll add to what Stephanie said too. I mean, we do have to pay attention to what goes on around the world. And certainly we do.
Mhm.
Stephanie and Chris and I are usually exchanging very early morning text about news around the world. But again, another big theme last year was to sell America and buy Europe and buy foreign markets. Well, if you folks haven't been following it, the Japanese yen is just hitting a 40-year low. You live in the United States, you live in dollars. I mean, the beauty in being in part of the American financial system is you have tremendous ability to diversify. Folks, I mean, this talk about having to be in these foreign markets, again, there's a lot of our competition that likes to promote that. I have one word for you, Japan. All you have to do, look at Japan or look at Venezuela or look at a lot of other, look at the Middle East. I mean, it's just, you can really get hurt in this kind of world if you really don't 100% understand what you're trying to do. A couple of historical notes I think they're just worth bringing up. I have a lot of people, and I know they read articles about trying to compare the USA to the 1970s. I was very young then, but I do remember the 70s very, very well, certainly on the gas prices. First off, it wasn't just gas prices being high, there were gas shortages. We don't have that going on today. Number two, back then, when we went off the gold standard, the dollar immediately went into a tailspin, similar to what just happened to the Japanese yen. It lost about a third of its value. That's where the inflation came from. We do not have that going on today. This is a very, very different scenario entirely. So it's just important for y'all to understand, that we're in tune with it. And I understand the headlines can be very scary, but the simple fact of the matter is corporate bonds have actually weathered this storm beautifully. And I know there's a lot of scary headlines out there about private bonds, private corporate debt. We're not in that at all. These are publicly traded. This is 70s where I'll ever talk about it. The preferred stocks that typically are very, very sensitive to interest rate moves, changes at the Fed. Preferred stocks have done very well this year. Financial stocks are actually on a very strong tear right now. So again, like I said, I think that you're going to be very happy with your portfolio. I'll finish on this, then I'll be quiet because Stephanie's got stuff to say. Earnings season is going to be key. I fully expect that, there's always like the old Clint Eastwood movie. There's good, bad, and ugly. There will be some companies that will miss their mark for whatever reason, the war, tariffs, just, I mean, all you have to do is look at what's going on in restaurants right now. There's a good example of that, but we'll see. Okay, number two, summertime. Summertime does typically it can be very volatile. June and September are usually the tough months. We're aware of that. What I will tell you, and Stephanie and I, we're just talking about this. This market's has climbed a wall of worry. It's had a lot of very bad headlines, a lot of things going on, and it finds a reason to go up. The simple fact of the matter is that I really, at this point in time, unless there's a massive fallout during earnings season or the Federal Reserve really raises interest rates, I really do feel that we're going to look back at 2026 as a good year. So I think that we're
Yeah.
going to continue to look that way. Our research continues to be very positive,
Mhm.
and that's what I'm paying attention to.
I think one of the things that you have to be really careful about is not to get greedy. I mean, we've had a good year, so it's an interesting juxtaposition with clients. Some get very concerned, and then some get greedy. And the greedy ones, you have to be really careful. You don't want to chase this market either. I think I get asked multiple times all the time, what do we see for the second half of the year? It is officially July 1st. um, if you took a snapshot from today to the end of the year, I actually think we'll be positive. I don't think we'll duplicate the performance that we've had in the first half because that was really strong. Our alpha is very high. I think it's like almost 10%. So I think you have to be a little careful about those expectations, but I do see several things I think that will happen that are going to be bullish. I think Warsh is going to cut. He is dovish. I think he's going to cut whether he likes it or not. Not a ton, but even a quarter point. It's something that investors are going to like. You do see crude prices are coming down. We're not feeling it at the pump yet, but they have to get rid of all their back storage that we have in the tanks and things like that. And I think you will see the prices come down. Although historically in the summertime, gas prices are high. So being a little elevated also isn't abnormal for the seasonality of this, right? But I do think that Trump is going to do everything in his nature humanly possible to end Iran. I think he knows that the midterms are going to be brutal if he doesn't. So I think we are going to get out of that. I don't know what that's going to look like. I don't know when. But when it does, it will be a bullish thing also, even though the Strait of Hormuz is open, which is great for oil. And lastly, historically speaking, investors prefer split government. They don't usually like it when the president has control of both chambers, and it doesn't matter which party. And so I do think that he will probably lose one chamber, and that's also a bullish thing that people like. So between now and then, between if Iran can end and gas prices, which also is one of the largest contributors to our inflation numbers, is gas. If inflation can get pewtered a little bit, gas comes down, a rate cut happens, Iran ends, and we have a split government by the end of the year. Those are actually all extremely historically bullish things for the market. So yes, I agree that multiples are high. Ken and I were just talking about this with a client a few minutes ago, but also the way that we calculate the multiples are a little different now. And I know Ken can explain this because he was just talking about this if you want to jump in on this part.
Well, I would just say this, and I know this gets a little bit in the weeds.
Mhm.
I know many of you have on your phones to sit there and look at the S&P 500 or the Dow Industrial Average. Well, the simple fact of the matter is there have been so many changes in these indices that I've actually believed they've been rendered useless at really gauging the market. I think that the Dow especially, uh, you have two credit card companies, a whole bunch of tech stocks, no mining stocks, no food stocks. It's not an industrial average. So the point being that we have actually had to depend more on our own research. But the problem is that when people say, well, the S&P 500 has never been at this record valuation before, it's because that the company that oversees that has been removing components that maybe there's some old line manufacturer from the Midwest that has a low valuation, and they're replacing it with some high octane AI play that's probably trading at 70 times revenues.
Yeah.
You're going to have the components. I mean, I am very suspicious of these moves. I don't think
Mhm.
they're necessarily good. And I would also just say this, you all know me, I'm not one to pull punches. I think any research, when you read anything in the paper about this valuation or that valuation or this time tested indicator using the S&P 500 is useless at this point in time. They have replaced so many components. They've changed the complete dimensions of this thing. It's no longer a valued benchmark. And
I
in
agree.
fact, I'll tell you a funny story. I just came back from the Morningstar conference. Morningstar actually heard the president of Morningstar say to somebody from BlackRock, we're no longer going to have the S&P 500 be one of our benchmarks. They're going to use the Morningstar 1000.
Mhm.
So it's not just me having
Yeah.
this opinion. The big rating agencies feel the same way.
I agree. And the thing is that most clients should understand is that the benchmarks, because there's so many ETFs that track the benchmarks, and those companies profit by the success of the ETFs, right? The benchmarks have turned into a business. It's not even used for analytics anymore. It's I think and actually the S&P and the Nasdaq, the overlap on them is extremely high. So I feel like they've been I completely agree with Ken that I think they've just been manipulated way beyond any part where you can use them as like a reference point. So we do have our own research. We do have our own benchmarks. We use those to track to the actual health of what we think the market's doing. Unfortunately, you can't get away from the S&P 500 and things like that. It's still going to be part of the news, but take it with a grain of salt because the top 10 companies of the S&P 500 represent over 45% of the benchmark. That's insane. And the fact that Elon was trying really hard to get SpaceX into one of these benchmarks, also insane. So the good thing is there's a moratorium on that for about a year. I do want to touch on that because we did have several clients ask us about SpaceX, and there's some very big IPOs that are coming down the pipeline later this year. Um, they changed the rules for SpaceX and they were allowing retailers in. We did have a couple clients that asked about it and that did elect to buy some shares pre-IPO price. Typically, we don't like participating in IPOs. If you actually check the history of a lot of the IPOs from the last 10 years, usually they're extremely volatile and they tend to go down at the beginning. I know SpaceX went up, but then it's kind of come back down. It's hovering around its IPO price right now. For me, I feel there's a little bit of what we call a pump and dump in our industry. I feel like everybody was talking about how this is the biggest thing and the greatest thing since sliced bread, and all these retailers can come in, and the minimum that you had to buy was 10 shares. I mean, I've never seen that before. So for us, it was a little scary, and it's not anything that we were going to promote. But the capability to do it, we do have. But I would caution people to be a little careful. The 30-day lockup window for when the early investors can get out is actually coming up in a couple weeks, and I think it's going to be very interesting to see what happens with that stock. But when you have something that's such an unknown, it's not usually recommended to get into it, but I can see why we had a lot of clients that were curious and interested in it. So we'll see how it plays out. But it was an interesting quarter. It was not a boring quarter at all.
No, no, no.
No,
Well, and Stephanie, I'll add to a couple other quick things that I think
please.
some folks should be aware of. I know that I've had some talk about, is this the time to buy gold? Is this the time to buy silver? Is this the time to buy Bitcoin? Here's the problem, and this has nothing to do with intrinsic value. As you all know, we also have our commodity company. I track commodities very closely. Another reason I think inflation levels are going to come down, I'm looking at commodity prices almost across the board, food, softs like cotton, gold, silver, platinum, palladium, they're all heading south. You don't have inflation spirals when you have core commodities coming down. But here's on the reason about not necessarily buying gold or silver is simply this. There were a lot of people who were very late to the party on the rallies of both of those and some of them, were buying in January. So you have, or I'm going to throw crypto into that too, bought Bitcoin and Ethereum and Solana at very high prices. The problem you have is this: they've all collapsed. I guarantee that every accountant is going to tell their clients, get rid of your losers and take the tax loss. A lot of those things would have been in taxable accounts. So there's going to be pressure to sell into any rally just strictly for tax loss reasons. So again, you can look at the rest of this year, seeing that just prices are going to be kept down on anything that's gotten crushed. So again, I just advise everybody, it's not that we're against anything or in favor of anything, but again, when you start looking at why things are falling out of bed, it's best just to get on the sidelines and let it play itself out.
Yeah. Yeah, I would agree. But like I said, I'm going to reiterate. I feel that we will have a positive second half of the year. As Ken mentioned early on, the bond market hasn't budged an inch. I actually am having a hard time buying things. That most of the portfolios are pretty good. We've had several calls, so I'm trying to replace that cash. We had a slew of them that just hit the last couple of weeks. So if you see your cash levels a little bit high and you have a blend of some kind or an all-income portfolio, no, I'm on top of it. I'm just trying to put the money to work. It's just a challenging market. It took my broker dealer 5 days to buy one bond, and we had to pursue that thing forever. So it's a harder market, but it doesn't mean I still can't get good yield. With that bond specifically, the prospect bond that I bought, because we bought the small deal size, the yield was actually about 8.5, 9, which is great. I could have bought the normal one, but it would have been 7. And I wanted to go after the small deals. So the deals are out there, just requires more work and more effort. But if you see a little bit more cash, that's normal. That's on me, and I'm gonna get it to work. Okay. Yeah.
Well, Steph, I think, probably
Yeah.
getting a little long-winded here, but I just want to tell everybody, Stephanie came out for it. We just had our launch party
Mhm.
for the Winning with Winans podcast, which you can see. Just go to the website if you'd like to watch it. We were fortunate enough to have the Lieutenant Governor of Nevada come on to talk about regional issues. So I think you'll all find it of interest. We're putting out new Forbes articles. I just wrote
Mhm.
a fun piece that talks about the different presidential administrations. I think regardless of how you feel politically, there's some good news there on any spectrum. And I'm going to continue to put out more Forbes pieces. I am going to write some pieces about looking forward about what a future bear market would look like. There's always boomerangs out there. There's always some clouds. It's our job to try to figure out what it's going to look like. I would just finish on this note. Stephanie brought up the thing about being greedy. Folks, I've been in the game a very long time, and including the dot-com bubble, the run up in the 80s and the 90s, and all this stuff. Look, there's always pullbacks, and I think that this one has a little bit different flavor to it because it's inter-industry pullbacks. But I would just always caution you that one, buy and hold sounds great until you're in a bear market. You've always got to be looking ahead a little bit. But I would also say too, when you do see some cash build up in your portfolio, we don't necessarily sell out of something and immediately want to put it to work the next day. We like to wait and see if we can get things at better prices. So
Mhm.
we're aware that cash is there. But again, just be patient. Let us do our jobs. At the end of the day, it's not about being fully invested. It's what the results are. And we do, we believe me, this is what we live for. So anyway, listen, I hope you are all going to have a great summer. I hope you have a great holiday. It's just like I said, there's a lot of reasons to be proud of what our country's accomplished, and we're all part of it. So have a great rest of your summer. We hope to see you sometime in the fall. And Steph, anything else you want to add, or?
No, just say that we're doing reporting as we speak. The electronic reports should be in your portals today, and the paper ones will be in the mail first thing tomorrow.
Yeah.
So you should get them soon.
Steph, one other quick thing I want to add. So I do get asked quite a bit. People are trying to time when to get us money.
Mm.
Just kind of keep this in mind. I've been saying it for a lot of years. The strongest months if you want to commit capital and new money, and again, I live in the gaming capital of the world, so I can make some odds bets here. You want to get it in October for the November, December, January run. So again, if anybody's saying, well, I've got this money sitting in a CD, folks, I'm not saying that you don't have to move it right this minute, but if you're looking for a time to give us money and let us get it to work, look at that fall. We're going to be getting rid of the election. Election will be over. We're going to know where the economy is and all that. But if you are looking at how can you squeeze out a few more decent points for the year, that's when I would do it.
Hmm.
So
Agreed.
anyway, everybody, take care now. Have a great summer. We'll talk to you again soon.
Okay, sounds good.